Okay, so we're going to go over rollover and what it is. And it's really just the interest that accrues for holding an open Forex position. So when you place a trade, you guys know that we're trading on leverage. And when we trade the one lot of the euro US dollar, we're trading 100,000 euros. And then we're selling whatever the equivalent is in USD at the time. Right now the rate is 1.30. So that means that we are buying and selling 100,000 euros and exchanging that for $130,000. So this is when euro USD is equal to 1.3000. Make sense so far? Okay. Now, unfortunately, everybody wants interest and they want their pound of flesh. And you're not just paying it for the money in your trading account, you're actually owing interest and earning interest for the positions that you have open. So to use, again, current examples, interest rates are at historic lows, and they use the overnight rate for setting the interest rates on a position. So the euro overnight lending rate is set at 0.01%. It's basically free money. And the US dollar has an overnight lending rate of 0.15%. These are annual rates. So it's actually pretty equivalent to what you're getting paid on a CD, almost nothing. But that does have a cost associated with it, and when you look in MetaTrader, it references it as the swap. But in the industry, it's more commonly known as rollover. So you have to pay interest for the positions that you do have open because they have value. And when we decide to buy the euro US dollar, that means we own euros and we sold dollars. In interest terms, that means that we are owed interest and we owe interest.
So that'd be bad because the US dollar's more.
Right, so if you're buying the euro, and this is in magical fairyland where you earn and pay the exact same amount for rollover. We'll get into the exceptions in a minute. But in the pure scenario, you're only earning 0.01% annual interest on your euro position, but you're paying 0.015% interest on your dollar position. So if you're buying the euro dollar, as if you held that position for a year, you would expect to accrue a loss of 0.14%, which is this minus this. If you did the exact opposite, so if you sold the euro dollar, you're going to only owe 0.01% overnight interest, but you're going to make 0.15% interest.
So are you assuming like you had a position open the entire year?
Yes. Now, of course, these rates change. These are overnight rates, which means that overnight they're going to change on a daily basis. So the amount will fluctuate slowly, but it does fluctuate. So this is in the hypothetical example where you bought the euro dollar, these rates never change, and you held the position for precisely 1 year. So this is bought euro, USD, and sold euro, USD. You guys following so far?
It's like one whole lot, right?
Yeah, this is precisely one lot because one lot is the equivalent of 100,000 base currency units. So our base currency here is the euro. 100,000 of the base currency is 100,000 euros. Okay. So let's actually go through and calculate what the rollover would be in our scenario of buying one standard lot of the euro US dollar. So here we owe, it's just 0.01% of 100,000. So we have this, the interest is equal to 0.01%. So 100,000 times 0.0001. Whoops. And we need to move it 3 decimal places, is equal to 100 euros. Of course, you got to put that back in dollar terms. So 100 euros times $1.3 per euro, you have a debit of $130 for holding the position for an entire year. And it's the same calculation with different numbers.
I thought that's what you get. The US
Oh yeah, I'm sorry. Yeah, this is, you're correct. Because we bought euros. So we only have a credit. Actually, let's just get rid of the sign. We have a credit of $130 for the year. Okay, now the problem is that we're going to owe more for the dollar position because it has a higher interest rate and we sold it.
Right.
So again, same calculations, different numbers, and thank you for pointing that out. So here we have $130,000 times 0.0015, and this is a negative number because we owe it. And does anybody have a calculator on their phone? We all do, we're programmers. Yeah, okay. 195. What did I do wrong? Did I, is this supposed to be 13?
Maybe.
Yeah, because that should be way different. I start this again.
I know. Sorry, that's why there's editing.
Yeah, yes, it is. That should be 13.
$13.
That makes a lot of sense.
$13 credit and $195 loss. So in this scenario, it's 182 is the amount of money that we're going to lose after 1 year in our hypothetical scenario of the euro-dollar exchange rate not fluctuating, of the overnight interest rates not fluctuating, and us holding our position for precisely 1 year. Make sense? Okay. Now the next thing is we need to go over the mechanics of rollover and how it's charged, because it's a little quirky. I'm stating the obvious here, but there are 7 days.
It's like going to be trading. They only give you 1 to 50. You know, they only let you leverage.
Yeah, that's
So that would assume like.
Doesn't matter if you had a position of 100,000 euros, you owe 100,000 euros.
So you owe the interest on the leveraged amount?
Yes. Yeah, it's on the leveraged amount is what the interest is calculated on. So when we opened that 100,000 euro position, we did that with $2,000 on 50 to 1 leverage, or we did that with $1,000 on 100 to 1 leverage. But you're not paying and receiving interest on your margin amount, you're receiving it on the leveraged amount, or paying it on the leveraged
So
amount.
do that with like in trading, I'd have to like do 2 lot size.
No, the interest is the same because you have 100,000 position.
Yeah, but to leverage that much, don't I have to double my?
Yes, so instead of using $1,000, now you use $2,000 to open the 1 lot trade. Right.
Yeah, it's still 1 lot.
Right. Okay, so rollover is 7 days a week, but we know that trading doesn't happen on the weekends. So in Forex, trading really happens from Sunday afternoon to Friday. But this is more of a technicality. So really, the only important days are Monday, Tuesday, Wednesday, Thursday, and Friday. But they need to charge interest for 7 days, even though these are the 5 days that are important. So what they do is they charge 1 day of interest on these days, and then Wednesday, by convention and for no good reason, you get charged the interest for Wednesday, Saturday, and Sunday.
Why don't they do that Monday?
I don't know, why don't they do it Thursday?
Or why don't they spread it out across the week even?
Yeah, why don't you pay 1.5 days? It's just, that's the way it is. So this is referred to as,
I guess you don't want to have, well, you might want to.
triple rollover Wednesday.
That's for the past weekend, right?
No, it's actually, it has nothing to do with the weekends. So if you decide to, okay, rollover occurs precisely at 5 p.m. Eastern time. So when you look at the charts of most brokers, it is based on broker time, but in the Forex industry by convention, this is the start of a new day. So 5 p.m. Eastern time on Sunday is actually the start of Monday. 5 p.m. Eastern on Monday is actually the start of Tuesday's trading day. And Tuesday's trading day concludes at 4:59 p.m. on Tuesday.
But on Wednesday, you get charged for the past Saturday and Sunday.
Even if you didn't have the trade open. So
Yeah.
if you decide very poorly at 4:59 on Wednesday that you're going to open a trade, so let's write this down. Wednesday, 4:59 p.m. open trade, and Wednesday at 5:01 p.m. you close the trade. So a total of 2 whole minutes you are either going to earn or pay triple rollover.
Oh, so it has nothing to do with the last weekend. They just charge you 3 times for whatever happened on that
You don't
day.
even
Yeah.
have to have it.
Oh, okay.
Yeah, so it's a market quirk. So if you hold that position precisely at 5 p.m., you owe interest. If you do not, you do not owe interest. Whether you if you had the trade open for 23 hours and 58 minutes, but you closed it before 5 p.m., no rollover.
No triple rollover.
But if you have it at 5 p.m., triple rollover. And it's the same day. It's the same concept on Monday, Tuesday, Thursday, Friday, except it's only single rollover.
Yeah.
What's to keep people from just, finding a favorable currency comparison and opening trades for 2 minutes every Wednesday?
Lots of people try that, and it doesn't work because of spread costs. So you notice the rollover rates are so tiny. We're talking about 0.01% per annum.
And
You divide that per day, and it's a silly amount. It's so negligible you don't really care. There are exceptions. So there's Golden Week, and this involves the yen. And there are days where triple rollover Wednesday becomes 9 times Wednesday, and you earn the interest for 2 weeks of trading.
Do brokers just do that to get people to trade with them or something? Is that just like a for fun thing, or is there an actual?
It's because Japan actually shuts down for 2 weeks.
Oh, I see.
So it's just,
be a yen pair or something?
yeah, so anything involving a yen pair in May has Golden Week, where everything just, you have monster rollover day, and it's just kind of the way it is. Yeah, people do try to take advantage of it. When interest rates were higher a couple of years ago, there was a big differential between the pound and the yen, where the pound had an annual interest rate of 5.25, and the yen, as it still is today, has an annual interest rate near 0. I think today it's 0.01, or 0.1. But the point is that there was a massive difference of 5%, and you could earn that on a leverage position.
So isn't that going to make the price spike?
Yeah, it does, because people want to earn this money. So
Yeah.
if you see,
So you
and this
get-
is what drives currency markets, is the actual shift in the interest rates. People chase yield. So if I can open an account in GBP and I can earn 5%, if I'm holding yen, that's looking really attractive to me. So I might consider the idea of converting my yen into pounds so that I could make this money. And this is actually referred to as it's called a carry trade. And it's the idea of using leveraged money to earn the difference in interest rates. It's possible and it can be lucrative, but the problem is that it depends on your timing of exchange rates. So if you expect that, let me think of a realistic scenario today. Let's say that the ECB decides to reverse course, and this is not likely to happen at all. But right now they're trying to keep their interest rate at almost zero. Well, let's say that they decided to stop intervening in the market and to charge a real interest rate. So the euro interest rate would go through the roof, which motivates people to put their money into euros instead of dollars, yen, Australian dollars, whatever. If you expect that trend to continue for several years, then that's a really good motivation for actually buying that currency, because not only are you going to earn the increasing differential in the currency, but more people are likely to follow the trade. And the higher an interest rate is, the more likely people are to buy that currency. That was actually the big reason behind Brazil's hot market as of about 2 years ago. Interest rates were 13, 14%. Everything was appreciating through the roof. So you could buy the Brazilian real and sit back and know that you were going to make 14% in reals. Now the problem is that if you top the market like you did at 14%, you earn 14% in reals, and then the price plummeted by 30%. So timing is critical. And that's why, that's the fundamental reason the market exists, is that's why people trade currencies, not just for exchanges of payments, but for speculation. That is entirely why people participate, because it's basically free money. And there's all sorts of examples. So oddly enough, in Poland, most of the mortgages are denominated in Swiss francs. And the reason was that the Swiss had a very, very low interest rate compared to what the Polish zloty was charging at the time. So if you could pay a 0.5%, why are you going to pay 5% to have it denominated in zlotys? Well, the reason is because the Swiss franc has been appreciating for several years, and now half of Polish homeowners are severely underwater because the value of their loans is appreciated by 20, 30%, and they only make their income in zlotys. So that's the risk of the market, and those are kind of real-world examples of why people decide to participate and why rollover is really important. This is the electronic form of how it applies to our traders, our customers speculating in markets. But the real mechanics behind it are more tangible, like in the mortgage example. 7 days a week, rollover, timing. I think that's everything. You guys have any questions on it?
So is it common for strategies to try to keep track of, I would make money right now, so I want to hold my trade at least until I hit my interest point for the day?
You could, but it's a silly risk, because if you think that it's dangerous to be in now, you're going to stay in risking in the euro-dollar an average of 120 pips of movement so that you can capture the equivalent of a quarter pip.
Okay, yeah, so pretty much worthless.
Yeah.
Now, is that something, a strategy, your current interest rate, is that something the strategy has access to at the market level, to be able to go out and query that? So it has to be fed that value from some other source, which means it has to...
No, it just has nothing to do with back testing. Nobody makes assumptions about rollover. It's not present in MetaTrader on a historical basis. It is available in real time, and I can show you guys where to find that, but it's not something that most people look at as a part of a strategy. And it is an important part, but it shouldn't be the maker or breaker. It should be kind of a little bit of juice. You use it to pad the margins a little bit, or it might be a drag on performance, but it should not be the primary reason why you're entering a trade now at 459 so you can capture the 10th of a pip of interest cost, and you pay 2.5 pips in the process. The one thing I also wanted to point out too is that everything I explained is kind of hypothetical, so you either lose 0.14% or you make 0.14% on an annual basis. Well, in reality, that's not how most brokers work, and it's a good way that they pad their margins. So instead of, this is how they make a slight amount of money for traders that aren't trading, is the difference in the rollover rates that they charge. So in the example that I sent you, and assuming that we opened MetaTrader and it was a perfectly equal market, you would see that buying costs you, well, I mean, MetaTrader shows you in dollars, but I'm just going to put it in a percentage. So this one has negative positive 0.01%, and this one would be negative 0.15%. And this assumes that you're buying. So if you net that out, you would expect the total return to either be negative 0.14% for buying Euro USD or selling Euro USD to be positive 0.14%. But what happens most of the time is that everything gets skewed against you. So this becomes a bigger number. It might be something like 0.2%. And this one becomes a smaller number, like 0.6.
That's nice.
I'm making this up. It's totally dependent by
You're saying
broker.
this is the broker does this?
Yeah, it can be the broker, it can be the liquidity provider behind the broker. But yes, the interest rates are market set and then they get shifted. And obviously somebody is earning that differential.
So obviously these are within the bounds of legal
Yeah, what
priorities
is the
based
basis
on
for the-
trading rules, and
Yes.
they can slide it by, a couple of points.
It is a cost, and I don't know if anybody that discloses it. I don't know who the ultimate beneficiary is, to be honest. I don't know if it's
Broker.
Well, that is my assumption, is that the broker is making that, and if they net their trades, they should be capturing that difference. So if you have 50,000 clients and most of them are piled into the euro dollar, there's only going to be a certain amount net exposure. You're only going to have maybe 10% of that total difference is actually long or short. So you can net out the difference between these two and keep all of it. And I mean, that's not super lucrative, but it's money sitting there and they take it.
A dime times 50,000 is
It adds up.
lucrative, yeah.
Yeah.
Especially when it's all electronic.
Yes.
So I guess I'm behind the time, but I thought that politically they were pressuring the eurozone to ease.
They are, and
But they're already way below the dollar. So, right?
yes. Well, the target headline rate in the eurozone is 1.25%, which is the result of the central bank intervening. So they're buying Spanish bonds, they're buying Italian bonds, basically the bonds that literally nobody wants. They're buying them so that the interest rates go down. And then in overnight lending, the markets are reacting to that. So maybe if I'm going to loan money, it's just, you have to make that call for your business, for your multinational corporation, and decide, is that, do I want to tie up money in junk debt for a year and get 6% in Spanish bonds, or do I want to loan it to the ECB directly and get paid almost nothing, but at least I know I'm going to get my money back?
Well, it depends on how long you're going to depend on being in it, and what you think the future's going to turn. Or if you think that's going to turn, then go ahead and camp on it now and get it for nothing.
Right.
If you can afford to be in it that long.
Yes, and that's why there are interest rate curves, and that's a whole different subject. But there's an interest rate curve, and it's supposed to look like this. Usually it looks more like that, where you have, so if you lend for a day, And let's use the US Treasury market as the simplest example. Here is, let's use bills. So bills are anything with about a 90-day coupon. So you can loan money to the Treasury for a month, for 90 days, for something like that. You can loan it for 6 months. Then you can buy a 1-year Treasury note. You can 2-year, a 5-year, and a 10-year. And each duration is supposed to get higher, but the further out you go, and then the 30 is going to be something like that. The further out you go, you're supposed to get a higher rate of interest, but it's going to be rather negligible compared to the duration. So the difference between overnight and 3-month is pretty substantial. The difference between a 10-year and 30-year, hypothetically, is supposed to be more substantial, but obviously the time involved is almost beyond comparison. So that's why in the example for rollover I cited that the overnight rate is this, because that's what you're using in the Forex market. But what people are really looking at when they're deciding whether or not to take out mortgages or to loan money in different sovereign bonds, they're looking at 1-year yields, 10-year yields.
It almost seems like it doesn't make sense to go past 10 years because that's a very long, 3 decades is a long time to tie something up.
In that market, I would agree, but there were people in the 1970s that caught the U.S. Treasury in the height of the stagflation when interest rates in the U.S. were at 14%, where they loaned money to the U.S. government when the short-term rates were actually inverted. So the yield curve actually looked like that. And people were taking the real easy money over 3 to 6 months, earning 17%. But the smart money locked up those interest rates at 14% for 30 years. They made 14% per annum. Compounded for 30 years. So the guys that bought the 30 years made just a killing. And absolutely, I mean, as close to risk-free as you could get at the time. Today, I would argue that's suicide, because I don't think the dollar would be around in 30 years, but that's a different story.
When do these costs get calculated? So every day at 5 o'clock, they say you gained, 2 cents or whatever.
Cha-ching.
Yeah.
But when do that fee get charged?
Okay, so interest rates are a really complicated subject, and they're actually the result of a huge scandal right now that I know none of you know about, and none of the people I know about, but everybody should be up in arms about, and it's the Libor scandal. Okay, so Libor is where overnight interest rates are set. It's not a free market, and it's actually voted on by a group of, I think, 30 banks. And it's all the normal culprits, the people that are despised, and rightfully so, the Goldman Sachs of the world, Barclays, RBS, any Bank of America, any bank that you've heard of that's international, they're probably one of the banks that set the Libor rates.
Citigroup.
Yes. So they all get to vote and decide what is the interest rate for the US dollar tonight. And when they set the rate, that's what every bank in the world uses to set its overnight lending rate.
They just pull it out of thin air, or they base it on something?
They pull it out of thin air. They just quote it. So they say, I think it's this, I think it's this, and there's a formula for we're going to take we're going to throw out the far most extreme ones, and we're going to go with the ones that represent the middle. So it's the most important market in the world because it affects everything that connects to money. It affects stocks, it affects real companies, it affects bonds, it affects mortgages, it affects currencies, it affects everything. And what happened this summer was the Bank of England actually got caught encouraging Barclays to manipulate the Libor rate. As you can imagine, banks have a strong interest in voting whether the Libor goes up or down, because that is going to affect all sorts of things, like how much do they have to pay savers in the CDs? How much do they have to charge for a mortgage? How much are they going to lose if all the mortgages that they've sold out over the last decade to non-existent people or people that have a pulse and no income, if the interest rates go too high, they're likely to default. So they have all sorts of motivations for keeping those interest rates as absolutely low as possible to benefit themselves. And that's what happened, was the banks have this big audit trail of colluding with each other to say, you vote this, I vote this, you vote this, I vote this, with the effect of pushing the overnight rates down and stealing effectively from savers. And it's not some conspiracy theory, it's all in the Financial Times, and it was a massive scandal in England. In the US, most people have not even heard of it, even though we're all the victims of it.
Sheeple.
When
Yes.
did this originate?
So, June?
No, I mean, when...
Oh, Libor?
Yeah, when did all that start?
I don't know when Libor started, but it's been the convention for at least 30 or 40 years. It stands for the London Interbank Open Rate or something like that. Anyway, it's set in London, but obviously that doesn't really matter anymore because all the banks are international. But that's the effect, is it's really just a committee.
With no government regulation or anything like that?
No, and actually it was with the
completely
active collusion of the Bank of England and the Federal Reserve.
Oh, that's nice.
They were encouraging all the banks to keep the interest rates low because it happens to align with the policies of said central banks. And there's many opinions out there that the central banks exist for the benefit of the banks that are on their committees that own them anyway. So,
So what should be the determinant of, perfect world?
a free market. So if I want to loan money to Joe, it should be bid and ask. If I want to receive 5% interest on my U.S. dollar deposit, then I should have the ability to sell in the
Demand and
marketplace.
supply of
Yeah,
demand for loans should determine.
yeah. It's not a market. It really is
I don't
just
know how I
voted
got away
on.
from that into this. This is like, it seems like OPEC or something.
It's the same thing.
Yeah.
I don't know, I'm just ignorant.
Most people don't know about Libor, but it's probably the most important financial organization that you've never heard of.
Best kept secret.
And I'm sure that's not a coincidence.
Of course.
What, I mean,
At least not so people hear.
Yeah, it's well
so
known.
if you Google this, you won't find out anything you just said.
Yeah, type in Libor scandal. Go on Google.
And the FBI,
You will see it.
and the FBI will be knocking on your door.
So I don't know
Yeah.
how it's kept secret. I mean,
It's not kept secret. It's just,
It's not advertised.
well, it's just most Americans don't really know what's a Libor, what's an interest rate. It's just not something that apparently the American media finds worthy of news. But it affects
Well, there's
everybody.
probably a little bit of collusion between the media and the market.
Well, I'm not going to be on the internet advocating conspiracy theories, but I will say that.
Oh, it's a theory. I didn't say
Yes.
conspiracy. You said conspiracy.
I'm just saying that Libor exists. That's the structure. Draw your own conclusions.
Oh, now he gets
Conspiracy
PC.
theories with Sean Overton.
Exactly.
Get visited
I get my
by
tinfoil hat.
federal agent.
All right. Do you guys have any other questions? Rollover, Libor, interest rates?
Now that I'm very disheartened, no, thank you.
Yeah.
Yeah.
Hang your heads. Go cry.